Welcome everyone to our latest webinar here at PANGEA-RISK. I'm Jack Brodsky, Country Risk Analyst, and today I'm joined by Bilal Bassiouni, our Head of Risk Forecasting, and Saif Islam, our Head of Asia Forecasting. Together, we're going to unpack a topic that we've been following closely at PANGEA-RISK, and that is how Gulf states are strengthening trade and investment ties across Asia, a pivot which has significant implications for the global trade architecture as we've long known it. Now, data shows that trade between Gulf nations and Asia has surged to new and unprecedented levels, climbing 14.4% from $451 billion in 2023 to an all-time high of $516 billion in 2024. Current forecasts suggest that this figure will rise even further in the coming years, with Asia set to become the Gulf's primary trading bloc by 2028. Now, such increased collaboration has been driven by expansion across various sectors, something that I know Saif is keen to dive deeper into later on. From my perspective, what's notable about the deepening of these Gulf-Asia partnerships is that it hasn't come at the cost of existing trade relationships, particularly with the United States. But overall, the Middle Eastern government's strategic realignment as essential trading partners for both East and West should allow them to exercise greater influence in a rapidly changing multilateral order. So Bilal, let's turn to you first. How would you characterize the main factors motivating Middle Eastern governments to deepen their engagement with Asia, and what channels of investment are they prioritizing in that shift?
Thank you so much, Jack, for the question. So as we may have been following over the past few years, we're seeing governments in the Gulf increasingly pursue ambitious diversification programs. And case in point here has been the Saudi Vision 2030, and also long-term development strategies in the United Arab Emirates and Qatar. All of it placing a lot of emphasis on non-hydrocarbon growth at the center of their economic policies. So those plans really require access to fast-growing consumer markets, and also advanced manufacturing ecosystems, and renewable energy know-how as well. So in practice, this means that deeper engagement with Asia, because this is where most of this incremental demand and technological capability now sits in the current atmosphere. But it's important to know that energy still provides this foundation. So Asian economies are the main buyers of Gulf oil and gas and petrochemicals. And this will remain central as customers, even as energy systems decarbonize in a lot of the deal making. So that long established trade creates trust and recurring revenue and political familiarity between the partners here. There's also a strategic dimension. So Gulf governments want to operate with greater autonomy in a more fragmented international system. So they are not binding or abandoning relations with traditional Western partners, including the United States, but they deliberately, at this stage, broadening their ties towards Asia in order to avoid overdependence and on any single bloc. So Asia is increasingly viewed as a durable anchor of global growth and an increasingly important source of technology and capital, particularly for GCC countries. Now, looking at the how these deals are being arranged, or what instruments are enabling them, they remain quite state-led at this stage. So sovereign wealth funds are at the core of a lot of this deal making. They take direct equity positions in Asian companies, participate in private equity and infrastructure funds, and build co-investment platforms with Asian sovereign investors. Also, national energy and industrial companies provide the second layer to this arrangement. So Gulf national oil companies and petrochemical firms enter into joint ventures with Asian partners in refining petrochemicals, LNG, and gradually in also hydrogen and ammonia. In terms of the types of agreements that we're seeing, comprehensive economic partnership agreements are the most visible ones that we've been monitoring, especially those concluded by the UAE with India and Indonesia over the past year. And this seems to be the primary tool of agreements between those trading parties. SEPA agreements, as they more commonly known as, remove barriers for non-oil trade and protect investment, and provide open channel for services, logistics, and digital commerce. So all in all, this what we're seeing is emerging frameworks between the GCC countries and the Asian region, and a number of the regional states to join or engage with groups such as BRICS or reinforce the Asian orientation of external policy.
Thank you very much, Bilal. That's very insightful analysis. Maybe turning our focus towards Asia, Saif, could you please tell us what's so attractive about Asian markets that Gulf investors are starting to pivot there more and more?
Sure. I mean, there are several factors which make Asia an attractive choice. For example, it's the world's fastest growing region. There are multiple resilient economies which continue to post strong growth figures despite the chaotic global trade and economic landscape. Asia obviously has a large consumer market and an expanding middle class. And regional governments are, really keen on attracting more foreign direct investment. As Bilal said, they are actively pursuing various, sovereign wealth funds as well as co-investment platforms to attract Gulf capital. And of course, Asia remains a global hub for advanced manufacturing, technological innovation, and integrated supply chains.
And on that, Saif, so what sectors would you say are attracting the most attention?
Sure. Well, energy remains a key focus for Gulf investors, but the emphasis has shifted toward renewables, clean power, and emerging technologies like green hydrogen. Another major draw is infrastructure and logistics, especially ports, transport corridors, and industrial zones that offer long-term stable returns. Technology and the broader digital economy are also becoming central targets, with Gulf sovereign funds investing heavily in data centers, fintech, EV manufacturing, and various AI-related ventures. Real estate continues to appeal as well, particularly commercial and industrial assets in rapidly urbanizing markets. And of course, there is growing interest in consumer-facing sectors, including agribusiness, food processing, and selected services that benefit from Asia's expanding middle class.
Thank you, Saif, and thank you both for such an engaging and enlightening discussion. At Pangea, as 2025 draws to a close, we are really looking forward to continue to track the growth and development in these Gulf Asia partnerships into next year and beyond. If forecasts are correct, investors should be optimistic about the opportunities across numerous sectors, whether it be infrastructure, technology, hydrocarbons, or real estate. We publish regular analyses on Asian and Gulf countries, highlighting the changes in politics, economics, and security that we expect to see in the months ahead. And by using these insights, investors can make informed decisions. So thank you, everyone, for joining us today, and we look forward to welcoming you again soon.